All right, guys, 3 big stocks. Are they value plays? First one, Best Buy. Let's pull up Best Buy. And I will say, I think Best Buy does a really good job of competing with Amazon because they can provide the service and support that Amazon cannot provide, and they're willing to match Amazon prices. So I think they're doing a better job of competing with Amazon than other people are. But the question is it a good enough job? So from a 500-foot perspective, we've got $50 billion in revenue, $15.7 billion market cap. We have a dividend yield that's very attractive, 5% almost, eating up $760 million of their cash flow. Now remember, we're not the people that believes that just because somebody's paying a dividend, they can afford it. We compare it to their free cash flow. Their last 5 years average free cash flow is $2 billion. So they can easily afford it based on that. And the last year was $1.2 billion. So it's a big chunk of their free cash flow. We prefer to see it under 50%, right, Mo?
Yeah.
So gross profit, 20.8%, which is almost double Amazon's.
Pretty good. Pretty good.
And a bottom line profit margin, 5 years of 3.8, last year of 3%. Very low PE. Why do you think that is, Mo?
Retail space.
Yeah. I think retail is just getting hammered because they're retail, which is understandable because the retail environment is changing. A lot of retailers are going to go under.
Especially from 2 or 3 years ago.
Oh, 100%.
When it spiked like crazy.
Yeah. You know, and it's like, okay, well, let's look at this. Now, look at this return on invested capital, Mo.
It's huge.
30%.
Yeah.
Guys, this is basically like a moat. If you see a high return on invested capital, that's kind of telling you this is a moat. The question is, can they reinvest extra cash at that level? I don't know. Is Best Buy really opening more locations?
I don't know.
Why don't you check it out in their 10K? So one of the things you can do, guys, on our website, on our software is you can go down here to annual reports. It takes you right to the SEC website where you can pull up their 10K. Mo's going to pull it up to see, are they opening, closing locations? Okay, here we go. Yep. So Mo, why don't you read out what's going on here?
So stores closed in 2023 were 14. Wait, I guess that has to be a plan. And they closed 20 in 2022.
And they only opened 1 store in 2023.
And 2 in 2022.
Oh, well, remember the fiscal year ends for Best Buy.
It's over, that's right.
Yeah, it's over for Best Buy.
So they closed 4. So they're closing less, but they're opening less by 1.
Yeah, so the total number of locations, 978 domestically.
Yeah.
Okay, let's go look. Is there another one for international? Keep looking, hit close, keep going on.
Here's international.
That's revenue and locations. There we go. Oh.
Nothing. They're not active.
Okay,
they're staying where they are.
They're trying to consolidate.
Yep.
Their idea is let's dominate the market we do. Let's do it well. Let's check out their income statement. So look at revenue here, guys. 39 billion 10 years ago, 50 billion recently, but it's been pretty flat for the last few years. So this is not a growth play, but with that high return on invested capital, they don't need to invest so much money back into the business, and they can take that cash to buy back shares and pay down debt. That's the big thing you want to look here. Are they buying back? Look at these shares they're buying back. 10 PE. They had 350 million shares 10 years ago, now 220.
Yeah. So they're repurchasing shares at an average price of $76.91.
And they're currently at $70.82. And as that stock, let's say the stock price falls in half. They're now buying back 2 shares for every 1 today. Mm-hmm. And if they keep their profit the same, let's say they average, in the last 5 years, they've averaged $1.8 billion in profit. Here's how share buybacks can work for you. 1.8 billion divided by 220 million shares is roughly $8.50 per share. Is that right? Roughly. Okay. Let's say they take all their cash flow and they're able to buy back 100 million shares. And they still make the same amount of money. Now, the earnings per share is roughly $15 per share. So they went from $8.50 a share to $15 per share. And if you still pay 10 times PE, the stock price is now $150. That's how buying back cheap shares can help you as an investor. But the big key here is, can they sustain this or even grow it somehow? That's the question. If they can do that and buy back, and people still have a negative look on Best Buy, they can buy back a lot of cheap shares. Is that one of the bulls of Best Buy, Mo?
Yep.
All right, what's another bull for Best Buy?
So this is an interesting one, and I actually almost throw this possibly in the bearish category. So they're trying to get into the healthcare space, remote healthcare space. So they acquired Current Health, a remote patient monitoring medical platform. What do you think about that?
I don't know.
I don't necessarily love it.
Yeah, I mean, healthcare is big and booming, and they have technology. I mean, maybe it would be good.
Maybe so.
I mean, who the heck knows?
Yeah, that was a doozy one when I saw that one.
That's a bear case or a bull case?
That's a bull case, according to bulls out there.
Yeah.
But I almost look at it as a bear case.
Yeah, that's interesting. Okay, so let's run it through the stock analyzer tool. And guys, with the stock analyzer tool, this is our most popular part of our software. It's part of all of our tools here. And remember, you can get the software $7 for 7 days at everythingmoney.com, $1 per day. It's going to change the way in which you invest, spending $1 per day to be able to understand what price to pay for a stock based on the income and cash flow in the future. And you get the community of thousands of people you can talk to and all of our software, all the updates. It's a no-brainer, guys. $1 per day. Go do it. So I'm going to do a 10-year analysis on Best Buy Mo.
Oh, you're going to do 10?
Yeah, because I don't know if I want to view this at a 20-year play. Actually,
Let me put it this way.
Yeah.
It's one of those, if it was not in existence in 20 years, I would not be surprised.
And that's one of the few times, because usually we ask that question when we're going to be surprised.
Yep.
Would you think Apple will be around in 20 years? I'd be shocked if they weren't. Best Buy, I wouldn't be floored if they weren't around in 20 years. I wouldn't be like, oh my God, what happened to this world? But I would be like, okay. Like, would I be surprised if they weren't around in 5 years?
Yes.
20 years, a lot can change in 20 years where, we're not really immersed into Best Buy.
No.
But I think their big advantage over Amazon is their ability to, you walk in, you talk to a Geek Squad member and say, I need help with this.
It almost seems like Amazon's never really gotten their brick and mortar off the ground, Well,
like not even that.
They've tried.
Not even that, like my new house.
Yeah.
I have Best Buy quoting me to install all the gear.
Are they trying to jack up the price like insane? Like,
it's pretty expensive. But the point is, I'm not going to Amazon saying, hey, can you guys install my gear for me?
Yeah, because it doesn't work for them, I
Right.
don't think.
Like, responding to, I owe the guy at Best Buy an email back. He emailed me a few weeks ago, and I was too busy crying about my mortgage to even worry about it. So I'm going to do revenue growth. I'm going to do -2, 1, and 4%. Okay?
Okay.
The declines in the business, profit margin. I'm going to do 2.5,
Okay.
3.25, and 4.
All right.
Free cash flow. I'm going to do the same thing.
I agree.
So guys, what I'm doing here, if you're new to the software, is I'm just looking at the history and looking at my projections of the future. Yes, the historical revenue growth has been there, but what if it keeps declining? Well, I'm going to go on a bear case on my low end. They're just not able to figure this out. They're going to decline 2% a year for the next 10 years. PE. If it's a declining business, I want a low PE, 6. Slightly growing, 9. And this one, maybe go 10 here and 14 here. Same with the price of free cash flow. Now, my desired return, guys, the lower the stock price, the better your return. So if you want a lower stock price, you have to have a higher desired return. So as you go larger and you want a higher margin of safety, increase your desired return. But it also makes sense because you're also making higher assumptions that are less likely to happen. So you want a higher return for those high assumptions. So since it's a not turnaround play, but I'm going to want
It's almost like a dying business.
12.5, 15, and 17.5%.
Yeah, it is.
Hit the analyze button. All right, low price of 37, high price of 88. It's on my watch list at 70. Doesn't mean I'm buying it at 70. But what it does mean is I'm going to start selling puts at lower prices. And maybe 60 is that price. Yeah. I don't know.
61 was the 52-week low.
Oh, wow.
61.05.
Okay, yep. And I don't own any shares of them, so that makes sense. Next company, guys, Disney. Now, we've done Disney 1,000 times, and I'm going to take a look at this. But the question is, we're going to skip, honestly, right to the stock analyzer tool once Mo has gone over the bull and bear cases. But as an example, this is a company that I would be shocked if they're not around in 20 years. So I'm going to do a 20-year analysis on them.
Floored.
All right, Mo, give me some bull cases for our good friend Disney.
Okay, so theme park admission revenue grew 23% due to the 17% increase in attendance and 8% from higher ticket costs.
Wow.
Again, I want to know what that level's coming from, though, because they went to basically nothing for a couple of months there, and then it came right back up.
Well, but that's been since COVID.
Since COVID, then
when do they reopen?
It's not super impressive.
17%. No, 17% foot traffic increase. If it was COVID, it'd been like an infinite % foot traffic increase.
Like nothing.
Yeah, that's what I mean. So
that's
I think
what I'm saying.
I think
it's coming off from those levels.
Okay.
That's why I'm like, okay.
Okay.
Hotel occupancy was 89% up from 84% in April of 2022. So people are staying there more. I like that.
And they just shut down their Star Wars hotel.
Did they?
Yeah, after a year.
Why?
Because it wasn't doing well? I don't know.
People don't like Star Wars? $4,000 a night.
$4,000 a night.
I'd rather go to the
Four Seasons.
Four Seasons.
It was less than that in Anguilla.
Yeah. All right. They're this is bear cases. They're repurchasing stock at an average of $99.11, 35 times year over year average net income.
Yeah, but I think their net income. So let's look at that actually. Now that we're here, let's look at their net income here, guys. This brings up a good point. 87 billion in revenue versus 60. But look at their net income. 4 billion versus 13. Their net income is still struggling to rebound.
Yes, it is.
Look at their profit margin in our stock analyzer tool. In the last 5 years, it's been 5.9%. The last 10 years, 10.6. So it was well over 11% in the first 5 years of this last decade. And look at last year, 4.7. The thing to understand about Disney is, how is their profit margin going to get back up? Because I have to think it is. They're at record revenue. And Disney Plus is, what percent is gross margin?
Yeah, that's a great question. But Disney Plus market share fell 5% in the first quarter of 2023.
Okay. And by the way, gross margin is the profit they make on every extra unit sold. So for example, if I sold an iPhone and this thing cost me $200, a physical product has a higher cost of goods sold, lower gross margin. But data, a streaming service, it's like all profit. So it's a very, very high gross margin.
Now I will say about that 5% fall in market share, it's worrisome, but they skyrocketed when Disney Plus came out. Remember the subscription rate just went through the roof.
Well, because of COVID.
Exactly. That wasn't
They
sustainable.
were hoping to get to like
a
100 million subscribers in 5 years, and they got there in like 4 months.
Right. So when I see that, it doesn't worry me. It's not like, oh boy, Disney Plus is dead. It's like, okay.
Listen, they got a great...
Went like this, it's probably going to come back.
And they've got a great, what's it called? Assets.
Yeah.
They own how many different brands that they can control on their Disney Plus platform.
They can monetize the heck out of everything.
Yep. All right, so let me do some assumptions for Disney over 20 years.
Okay.
I'm going to do 3% revenue growth, 5 and 7.
Okay.
For profit margin, I'm going to do 7, 10, 7, 11, and 15. If they keep growing that Disney Plus subscription and get higher margins in there, over a 20-year period. Free cash flow margin, oh boy.
I'm going to go a little lower.
I'm just going to go 6, 10, and 14.
Okay.
PE, I'm going to do 16, 19, and 22. Guys, this is a huge moat company. Moat City here. Moat City. Should I be willing to pay big premiums for them? Absolutely. Absolutely. I want to pay a big premium for Disney. Absolutely. That's why I'm putting a higher PE in there. It absolutely justifies a higher PE versus Best Buy, we just did, which is potentially a dying company. Who knows? I got to get my money through the cash flow and buying back shares. Yep. All right. Desired return. Now, since it's a high moat business, maybe I'm okay I've already beaten up these numbers quite a bit. Maybe I'm okay saying, okay, I'll do a 10% return here, 11.5 and 13 on the high end.
All right.
Okay. Hit the analyze button. Stock's currently at 90. We're almost there.
Wow.
40 to 50 on the low side, 130 to 140 on the high side, 80 to 90 on the middle. So I'm going to add it to my watch list.
And their 52-week low was in December, $84.07.
There you go. All right, final company, Discover Financial, DFS. Now, guys, Discover does have a banking aspect, but I'm going to analyze it based on them purely doing credit cards like a Visa, MasterCard, American Express, okay? So I'm going to tell you right now that you should understand their banking portion. And we don't understand banks very well, so we don't really get involved with that. But we're going to look at Discover here and where it looks. Now, Mo and I wrote a lot of puts on Discover right here, hoping it would fall back down.
Yep.
Right after COVID. It didn't happen. We never got our Discover Financial shares. And that's one of the risks of writing puts. All right, dividend yield, pretty healthy, 2.7%, pays out $700 million, and their free cash flow in the last 5 years has been $6 billion, and the last year was $7 billion. Yep. Pretty awesome.
Money safe.
All right. Profit margin, gross margin is 100% because it's all transactions. Yep. Okay. And their bottom line profit margin is basically the same, 28 and 29% over the last 1 year and 5 years. So very consistent business. The question is, are they going to grow? Now, the good news about Discover is they're probably the least. Tim, we have Dynasty Owner and we have Everything Money software. What percentage of the people use Discover? 5%?
Yeah, less than that. It's Visa, MasterCard.
Yeah, no.
Yeah. So Discover, the plus side of that is there's a lot of potential. And they do have a lot of the Discover dinner club and all these things, but there's a lot of growth potential as the world grows, maybe do some international. So there's still a big market space they can chip away at, potentially. The bad news is they're not the biggest player in the market. So what are you laughing about?
My first credit card I ever had was a Discover.
Was it really?
I used it for a couple of months and I'm just like, no one takes this damn thing. So I got to go somewhere else. I went to a Visa.
Now let's look at analyst estimates here. $13.45 a share this year, and the stock's selling at $100. Do the math. That's what, 7 times? Not even 7. That's 7 times, 7.5 times EPS, PE. 2025, $17 a share. Look at this revenue drop they're having come out here in 2026.
Yeah,
that's interesting. But not much revenue growth, but it's there still. But guys, remember, with Discover, as the world becomes, as inflation hits and more and more people out there spending more money, every year that inflation drives up the cost of everything, they're going to get an increase in revenue, right? So they should at least get inflation as their minimum threshold for growth of their revenue. All right, so let's see what we can do in the stock analyzer tool. I'm going to go with 3, 5, and 7% also with Discover.
Okay.
Profit margin, I'm going to do 28, 28.5, 29. Oh my God, look at that free cash flow margin. 45, 49, 51. PE, boy, I mean, this is going to be huge. 13, 15, 17. Desired return, 12, 13.5, and 15. And the reason being is,
why?
What was that?
Why?
I mean, they're not the biggest player, and what's going to happen? Could they get wiped out? I don't know. So I want a bigger return for them. And guess what? It's all green here. Mm-hmm. The question is the banking part something I don't understand? Is it really a bank? Mm-hmm. If it's not a bank, we need to get serious about this company, Mo.
Yeah.
We need to get really serious. They have a low price of 178 to 285, high price of 220 to 400. Yeah. But the question is it a bank? What percentage of its business is banking?
Yeah.
So guys, that's the stock. That's the video. If you like this, everythingmoney.com. $1 per day for 7 days. Just try out the software. If you don't like it, no commitment. If you do love it, you're going to be happy you did. Thank you very much for your time.